Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. So it's the first week of February and I'm back in the virtual booth, in other words, my office at home rather than an actual studio for this podcast. And it's been a fairly tough start to the year for share markets around the world. The extent of declines vary, but several key share market indices, including New Zealand's, have retreated by around the 10% mark that commentators technically refer to as a correction for share markets. The tech-heavy Nasdaq has been down closer to 17% from its late 2021 highs at one stage during January. After an unusually flat 2021 for New Zealand shares, this wasn't the start that local investors had been hoping for. So joining me today to discuss what's been happening and share some thoughts on the outlook is Greg Smith from Devon Funds Management. This is Greg's first podcast with me, but his name and voice should be familiar with many listeners because Greg has been in the business media a lot over the past 20 years or so. So welcome to the podcast, Greg.
Chris, thank you for that introduction. Very kind. Great to be here and really excited about it.
And you joined Devon last year. Can you tell us a bit about your new role there?
Yeah, so basically I'm heading up retail here. So really it's about sort of strengthening the retail ties to the advisor network, but also to retail investors and leveraging what's a great brand and a fund manager with a great track record. So, really excited about it. It's a great team and I knew actually a couple from sort of prior days. So that was quite nice as well.
Yeah, and we've had many good podcasts with people from Devon, and it's neat to have you on board. But before there, I know you spent a long time at Fat Profits, which is a name that I came across a lot when I was in Australia, and you were head of research there. It's a high-profile Aussie business, but you did that role from New Zealand, is that right?
Yeah, that's right. So was at various offices over the time with Fat Profits, and had a great time. But ironically enough, was running the research department from New Zealand with our analysts largely based across the ditch. And as you can imagine, that all became quite challenging. With the arrival of COVID and not even getting a chance to sort of attend a going away bash or the Christmas parties. So, but it was a great time there. But really excited about this role, and it was tyranny of distance, I suppose, as part of it.
Yeah, it's something that we're all grappling with, and you're used to working remotely to a certain extent from that situation, I guess, with being here, but a lot of the team over in Aussie.
Yeah, that's right. Quite ironic. Joining some Devon just sort of prior to that August snap lockdown that we went into. So sort of the work from home thematic was something I'd been used to for a while. So it sort of continued for a few months, but obviously we got out of things towards the end of the year, which was fantastic.
Yeah, I wished for a better year as my New Year's resolution at the end of 2020, but I didn't even dare think along those lines at this New Year's. But it's certainly been an action-packed month so far. Now, and on that front, there's a couple of overlaps with our roles. You're regularly interviewed on the radio to discuss markets as well, and I know that this isn't the first time over the past week or so you've been discussing market volatility. And so listening to one of your podcasts and reading your market reports is why I thought you'd be a great guest for this podcast. So let's get into it. And having read a bit of the stuff that you've been writing, let's start with inflation and interest rates, because they come up pretty quickly in most people's list of worries at the moment. We've been talking about it for a while, but that certainly seems to be one of the main things that's bugging markets at the moment. And why do you think markets are reacting so negatively, having taken a bit of inflation and talk about central banks hiking in their stride until only a couple of weeks ago? Yeah,
it is amazing, isn't it? Here we are in a pandemic, and we've got a new variant to deal with. Yet it's something a bit more old-fashioned that everyone's worrying about, the two I's, inflation and interest rates, and how they're inextricably intertwined, as it were. Look, I think perhaps the sort of reason there's been a shift. Of course, last year we had not even just last year, we had unprecedented stimulus pumped in globally across the financial system. history would have told us when that happens, that often drives inflation. The whole idea was to re-inflate economies and be a safety net, I suppose, for what was going on with COVID. And I think last year the message was, look, we need to do this. We need to administer the medicine, as it were, to the patient, as to the global and local economies. And consequences of this would be some inflation, but that would dissipate over time. And I think we were getting that tune from the central banks as well. Remember, we had the Fed telling us that it was all sort of transitory, should I say, in terms of those inflationary pressures. And then there was a change, wasn't there? We sort of knew interest rate rises were coming. We already had those in New Zealand last October. But then it was that sort of sea change. Okay, 2022, here we are. They actually are going to be rising globally this year. And these inflationary pressures, we suddenly started getting told, maybe they're not so transitory. Maybe they hang around, and maybe we do need to act a bit more vigorously than perhaps thought. And I think that's what's unnerved investors a bit, as we get into it this year.
Yeah, and that transitory nature of inflation is so interesting. I mean, for a decade, and the problem with inflation was it was too low, and then put a pandemic on top of that. You can understand why central banks were even more worried about inflation being too low, but here we are 2 years later, and the discussion is about, is it transitory, or is it something more permanent? And we've certainly, as a team of economists at ASB, gone out of the transitory camp and are worried about some of the longer term capacity constraints that we're seeing. And what's your take? What camp would you put yourself in with regard to how long this inflation's going to hang around, Greg?
Yeah, well, it's certainly interesting, isn't it? If you take a historical perspective, just looking at the last 20 years, you've had two big prior events, haven't you, with the dot-com crash, and then you obviously had the GFC, and you had lots of stimulus administered in both those situations. So I think that's why there was a bit of a belief, as you say, about transitory. So look, I think as things stand, there's probably sort of two sides to it, as there is every sort of story. I think there's some pressures that maybe do ease a bit as supply chains ease, and we've seen some of those blockages really come to force. And if you look at the outlook statements from some of the large corporates, including some of the tech names in the US, that are saying these supply chain pressures might start to moderate. I think even Apple sort of made those comments. So I think there's that side of things. But then there's the other side that, they might be a bit more persistent. Obviously got rents rising, but we've also got wages. We're looking at pretty full employment markets pretty much everywhere globally. And wages are starting to rise. How is that all going to play out? And I think, I do agree that side of things might be a bit more persistent. But time will certainly tell in sort of the months ahead.
Yeah, you will certainly, it's the wage pressure's understandable. And even though we're starting to see wages go up on an annual basis, when you're getting CPI prints of close to 6% here and even higher overseas, you can understand why the worker's going to be really pretty keen on getting a pay increase just to keep their head above water with the sort of pressures we're seeing on prices in the whole economy. And so there's quite a bit to worry about on that front. But meanwhile, the COVID news has been pretty negative, but investors took that in their stride over the past year, including those record highs that we mentioned for offshore share markets, at least in the fourth quarter of last year. Has it surprised you that we've taken the COVID developments, particularly with this latest variant, in our stride over that period late last year?
Oh, for sure. When you look at the whole, if you go right back to March 2020, we all thought it was sort of, a lot thought it was Armageddon, and then obviously there was a sort of a repricing. And then there was the reality that, yes, look, central banks would come to the rescue, governments would come to the rescue again. And of course, a lot of companies have been turbocharged by the pandemic. You think of all the stay-at-home stocks led by the technology sector, which has led the way on a number of fronts over the past couple of years. Of course, we had the vaccines, which have come along as well, and I think that sort of helped to ease fears. And then markets, ultimately are forward-looking. So we're looking at the world reopening. We're in a little bit different situation here at the moment in New Zealand, but much of the world is getting on with it. I speak to people in the UK, speak to people in Australia. They are starting to get on with life. pursuing different strategies, of course. And I think markets are sort of looking forward to that. We've got through the hard yards. Economies aren't going to roll over. In fact, they're going to reinflate, and there's going to be some growth there as well. So I think that's why.
Yeah, there's so many themes. And thinking about the New Zealand market, we've really been in the same boat as offshore markets over the past couple of weeks in terms of the decline. But here that comes on the back of that flat year last year for shares, in contrast to global shares that went very, very well. And another thing that's different here is we've got a central bank that's actually raising rates. They stopped buying bonds last year and they started raising interest rates at the end. So we're a bit out of sync in a number of ways. And what do you think of the local market's performance over the past year or so?
Yeah, I mean, look, it's pretty interesting. If you look at the first 3 quarters or so of last year, the New Zealand market didn't do too badly. And even that snap lockdown in August, the market actually embraced that. New Zealand market actually did quite well during that period. But you look at what the catalyst was, and of course, the RBNZ did delay what was meant to be a laydown misere in terms of a rate hike due to that lockdown. But then, of course, they went in October, and as you say, very much out of sync with the rest of the world. And I think we were only beaten by Norway from recollection in terms of central banks to raise rates. So I think that was the cold, hard reality of New Zealand raising rates while the rest of the world wasn't. And obviously we're a very dividend-heavy, dividend-centric stock market. I think that certainly sowed the seed. You scroll forward to the end of last year, and we were heading for a 5% decline calendar 2021, and we're obviously saved by good old Santa came to the rescue, a little bit of global markets late December, didn't we? We finished sort of slightly around about flat there or thereabouts. So I think there was that. There's the New Zealand market being dividend heavy, being a little bit less diverse than a lot of other markets, also obviously lacking that technology element to the same degree as well. So I think that all goes into it. Also, you had specific stories. Let's not forget Fish and Paykel Healthcare, big beneficiary of the pandemic. That thematic started to moderate, didn't it? And then obviously you had other names going backwards as well. Think about A2 Milk, and initially it was going to be all okay. April, May, everything was looking pretty good, and then the update from coming, it wasn't so good, and obviously that stock went into reverse and had a bit of an impact on sentiment generally. So I think there was some of the themes when I look back and try and sum up how our market's gone over the last year or so, and obviously we've underperformed into 2022 as well. But I think it's important to take a long-term perspective on the value in our market and some of the things which may drive it going forward.
Yeah, I think the two things I always try and focus on, particularly when we've had a tough year like last year, is firstly, over the longer term, like if we looked over 10-year performance, the New Zealand market's done incredibly well. And the second thing I think about is the fact that fund managers such as Devon tend to look at the Australasian market rather than just the New Zealand share market because of the eclectic nature of the New Zealand market and the fact that there are some pretty big sectors that are that you couldn't invest in if you just treated New Zealand as your investment universe. Yeah,
that's absolutely right, and you make a great point about that long-term perspective. How long were we sort of talking about New Zealand as the rock star economy, and the New Zealand market could sort of do no wrong for a long period of time there, outperformed. So you've got to place that in context. I completely agree, and for sure, the Kiwi exchange has been a shrinking market to a certain degree. IPOs have been quite thin on the ground. So in terms of, it's quite easy to broaden the net and look at the Australasian market in totality. You've got a lot more sectors to choose from, a lot more companies, and so I think that you're completely right about putting that all in context.
Yeah. Now, another point that you touched on a little bit there was the high dividend yield from stocks in New Zealand, and that was certainly pretty appealing for investors at the time when term deposits went down so much. I think back to 20 years ago, and when you could get such high term deposit rates here, it made it pretty hard to sell a New Zealand share portfolio. But as those term deposit rates have got lower and lower and lower, the high dividend yield of the New Zealand market's been really, really popular. So it's understandable that on the other side of it, we're sensitive to rising interest rates in the economy, and over the past 6 months or so, our term deposit rates have gone from around 1% to knocking around the 3% mark, which does impact investors' thinking. But the other interest rate sensitivity, I guess, is when we look at something like the NASDAQ. That's very tech heavy, a lot of growth stocks in there which are interest rate sensitive, and that's down by more than the S&P 500, for example, a significant amount more. What are your thoughts on how that's playing out in America with that divergent performance that we're seeing?
Yeah, look, I think that, and we think at Devon that rotation from growth to value gets further momentum over the course of this year. And I think, you were looking at a situation when, particularly when you look at those mega cap stocks, we're talking about companies with $1 trillion plus market capitalization. Yeah, many of which had done very well, obviously during the pandemic from the stay-at-home thematic. That is, and you think of those FANG stocks. But yes, the valuations elevated, really lifting the bar of expectation. And when you look at rising interest rates, which are used to price future cash flows, which is such a big part of the equation for growth stocks, I think that's a little bit problematic. Growth rates were incredibly high through the early stage or through the mid to recent stages of the pandemic, but they're starting to moderate, and you're starting to see this come through in the latest earnings season over there. So I think that rotation probably continues. I think companies that deliver will continue to be well rewarded, and we've seen a few examples, and we might be able to chat about those in a minute. But those that miss expectations are possibly going to be punished. So as we're pointing out, if you look beyond those sort of top 10 or 20 large cap tech stocks in the US, some of the share prices, I think it's around about 50% of the NASDAQ are down 50% or so from their 52-week highs. So that process has already gotten well underway, but valuations certainly aren't cheap. So I think, there's going to be that focus perhaps more on value, particularly as interest rates and bond yield curves are rising.
Yeah, it's an interesting backdrop. And if we look at the results, as we're getting company reports out for the fourth quarter now, there's some pretty spectacular results coming out, but also there's some pretty spectacular responses to them. Are some of the share price movements you're seeing in response to company announcements pretty big compared to what you'd expect?
Oh, yeah, absolutely. And the volatility has been fairly immense. If you look at the recent weeks, you've seen moves as well, not just over the course of the day, but in the last hour. I think that's all about that bar of expectation, also a bit of uncertainty about what the Fed, of course, was going to do. Generally, if you look at the earnings season in the US, it's actually not been too bad. 80% of S&P 500s that have reported thus far, around about a third of the index, have exceeded expectations. We've got around about another 100 reporting in the coming days. So generally, it's gone pretty well. But as you suggested, that there's been some hits. So Apple was a great one. They delivered in line. The whole sort of saturation with iPhones is sort of gone out the window. They're releasing new models and they're doing very well. But the misses have been harshly treated. Netflix, missed by a huge margin in terms of the subscriber outlook. And it's also not just about what's gone, but it's also about the outlook. Massive reaction to Netflix. Similarly, Tesla. The fact that Elon came out and said that we're not going to produce any new models this year because we're chip challenged. I mean, there was a massive reaction to that as well. So the markets are in no mood for negative surprise at the best of times, but I think that sensitivity has been heightened. There's been some other great results. So from some of the bellwethers over the course of the season, which already gives us a bit of confidence. If you look at Microsoft, they're doing very well. They're certainly a bellwether. Also, the credit card companies, including Amex and MasterCard, shows the consumers in relatively good nick. So, I think there's a lot of takeaways, but there's a divergence between those companies that are meeting expectations or exceeding and those companies that are sort of coming out with a negative surprise or two.
Yeah, there was one day last week when the US market was down at about 4% when I got up in the first thing in the morning, and then by time, probably like you, at about 9 o'clock when I'm starting to look at the close and tidy up my comments before I launch them out for the day, it was back to being in positive territory. So big swings, and those days don't happen very often. To me, remind me of why I don't try and time the market and prefer to take a longer term view. What do you think of those sorts of days, and more generally, what do you think investors should focus on when we start to see that sort of turbulence where the markets are getting very volatile within a session?
Yeah, I mean, it can be quite unnerving. I guess particularly if you're, if you're trying to, as you say, time the market or trade the market intraday, anything like that. Look, we're focused on the situation as investors. I think what we're seeing at the moment, there's going to be plenty of challenges over the course of what remains of this year. We're only a month into it. COVID's still with us. A new variant may even come along. There's a little bit of uncertainty about what the Fed is doing, and obviously other central banks tend to follow that. Quite hawkish in terms of that recent meeting and recent press conference, but that could change as well. We've got other things. We've got Russia and Ukraine. We haven't talked about that. But there's plenty of challenges for investors. So, I suppose the old saying is, cool heads prevail, and I think that's probably the right thing to do as an investor. Obviously, respective to your own situation, but look beyond perhaps short-term volatility. And perhaps what's on the other side towards the end of this year. We're seeing a lot of positive stories from the corporate sector about the outlook. We're seeing economies still set to grow this year, perhaps not as rapid growth as we've seen last year. So I think that's all a favourable environment. But I think it is very important. I think we're seeing, as alluded to, signs that the markets generally are becoming a little bit more choosy, a little bit more picky. There's particularly with respect to reactions to results and the like. So I think now more than ever is the best time for sort of investors to check in, focus on quality. I think that's something we're certainly doing at Devon. So we're looking at companies that perhaps may be cheaper, that may have been cheaper than they were, but have got great businesses, good pricing power, and really importantly, good balance sheets, because that's going to come into focus as well, particularly if bond or an interest and effectively lending rates are picking up. So I think it's now more than ever an important time to sort of maintain that financial discipline as an investor.
Yeah, that one comment there about pricing power is relevant. I mean, none of us as consumers like inflation, particularly when our wages aren't keeping up with the inflation rate. But to a certain extent, it does show that that some businesses have got good pricing power. There's a lot of demand out there in the economy. So the flip side of this inflation pressure we're seeing is the reflection that businesses are able to pass on higher prices and protect their margins, which is a reasonable development. And the question for me is, when we're talking about this persistence of inflation, and my role as an economist, is just how high rates will go up. Our forecasts have mortgage rates in the sort of 5 to 6% range over the next few years, which from a historic basis is actually still pretty low. And likewise for corporates, the rates are higher than what they were a few years ago when we think about interest rates, but they're still not painfully high like we've seen in some periods 10 to 20 years ago where rates were much higher. So there's some real positives in this backdrop as well, isn't there?
Yeah, absolutely. And you've hit the nail on the head that regardless of the environment, inflation, whether it's going to ebb away as supply chain pressures ease, or whether it's a bit more persistent, it seems to feel like it's going to be around to a certain degree. Interest rates, don't look like they're going to be heading down. They're going to be heading north again. To what extent that is remains a question. But if you're in a company that's in a reasonable industry, and also cost pressures were probably have been a consistent theme, certainly over the last 6 months, as you say. So, those companies that are in a good position, to pass it on, can mitigate that impact, can maintain that margin strength, and ultimately can, maintain those returns to shareholders, particularly for some of the dividend heavy companies that sort of operate in the New Zealand and also the Australian market.
Yeah. For us and for our investors, I think these periods of volatility highlight the importance of getting advice, that's for sure. And one of the things which, whenever we're looking at periods of time like this, none of us like it, but actually drops of this magnitude, around the 10% sort of level, do actually occur reasonably frequently. And it's a bit of a pain when it interferes with everyone getting on with the important stuff in January, like having summer holidays and watching the tennis and the cricket. But they do come along and rattle markets once every year or two. Making sure that you've got the right investments for your goals, sticking with investment plans is really important to do at times like this when it's very volatile. So, hey, thanks for joining me with your thoughts today, Greg. I really appreciate having you on the show, and hopefully our listeners really appreciate that there's some quite positive stories going on in the market at the moment with some of these company results and some of these businesses you're looking at.
Yeah, many thanks, Chris, and my pleasure to be here, and I look forward to doing so again. And, I really enjoyed it. Have a great day.
Okay, thanks, Greg. Appreciate it. Thanks for listening to the ASB Investments Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.